All right, let's get right into it. For years, we've all heard the warnings about the US national debt, right? But something's different now. The math is actually starting to break. We've hit this critical inflection point where the numbers on a spreadsheet are becoming real-world problems. So this isn't just another debate about budgets. It's a fundamental shift in the entire American economy. And here it is. This is the headline that really changes the game. For the very first time, the U.S. is spending more money just on the interest for its past borrowing than it spends on the entire military. Just let that sink in for a second. The cost to service our national credit card now outweighs the cost of national defense. This isn't some future prediction. This is happening right now, and it's completely rewriting where our tax dollars go. And this chart, wow, it just lays it out so clearly. You can see it right here. For decades, defense spending was this massive, almost untouchable piece of the budget. But now that silent, compounding power of interest has just blown past it. What you're looking at is a massive reordering of our national priorities. And it's not being driven by choice. It's being driven by the cold, hard math of our debt. And hey, it's not just us saying this. Billionaire investor Ray Dalio calls this a classic end-of-cycle debt crisis. And the problem, as he points out, is really twofold. We are creating way too much debt, and we're doing it at the exact moment the world is getting a little hesitant to buy it. It's a classic supply and demand problem, and the consequences could be huge. So that brings us to the core of this whole thing. We've officially reached the tipping point. All those theoretical risks about high debt, they're not theoretical anymore. They're becoming real, unavoidable economic issues. So what was the final push? What sent us over the edge? Well, it wasn't some slow, gradual drift. It was one single, massive event that basically acted like an accelerant. Let's break down that catalyst. The fuse was really lit back in July 2025. That's when the One Big Beautiful Bill Act, or OBBBA, was signed into law. This one piece of legislation, which was designed to make some earlier tax cuts permanent, just fundamentally changed the country's financial path overnight. And here is the price tag. When you factor in the added interest costs that come with it, this one bill adds a staggering $4.1 trillion to the national debt over the next decade. Let's be clear, that is not a small tweak. That is a fiscal earthquake. Now here's where it gets tricky, because the effects are deceptive. This table from the Yale Budget Lab explains it perfectly. At first, we get what they call a sugar high, a little temporary boost to the economy. But look at the long-term price we pay. That huge debt load eventually drags everything down, shrinking the economy by 3.3% by 2054 compared to what it would have been. We're literally borrowing a tiny bit of growth from a much, much poorer future. Okay, so this new mountain of debt, it doesn't just sit there. It creates this dangerous, self-feeding problem. Let's walk through how this spirals into a vicious cycle. It all starts with the annual deficit. In fiscal year 2025, the U.S. spent $1.8 trillion more than it brought in. That's the shortfall. And to cover that gap, the government has to borrow money, which of course adds to the total debt, and, this is the key part, it adds to the future interest payments we have to make. And that leads us right into something called the interest trap. It's basically a treadmill you can't get off of. You have to take out new debt just to make the interest payments on your old debt. And when that happens, the total debt just explodes. Even if you don't spend a single new dollar, the debt literally starts feeding itself. And the numbers, they prove it. Projections show that in just 10 years, the annual cost of just servicing our debt is going to nearly double. Up to $1.8 trillion a year. That's an extra $800 billion every single year just for interest. This is the interest trap in real time. And there's another nasty side effect too, called crowding out. Think about it. When the government is borrowing trillions of dollars, it's like a giant vacuum cleaner sucking up all the available money in the economy. And that means there's less money left over for businesses to expand, for entrepreneurs to innovate, or even for you to get a good rate on a mortgage or a car loan. Government debt literally starts crowding out private growth. So this path we're on is just not sustainable. It forces us towards a crossroads with no easy exits. Let's go through the three most likely and most dangerous scenarios that could play out from here. So we've come to a fork in the road. And honestly, neither path looks particularly great. Path A is what's called a yield spike, where the market basically loses faith and forces interest rates up. Path B is Fed monetization, where the central bank has to step in and, well, print the money to pay the bills. Both have really severe consequences. So scenario A is what they call the bond vigilante revolt. It's a cool name for when big investors basically say, nope, we don't trust this anymore, and they demand much higher interest rates or yields to lend the government money. Now, this isn't just some Wall Street problem. The 10-year Treasury yield is what your mortgage is based on. A spike there means a spike in your mortgage rate. How much? Well, one estimate says it could add an extra $165,000 to the lifetime cost of a typical home loan. That's a direct hit to your wallet. Now, if those bond vigilantes do revolt and nobody wants to buy the debt, that pushes us towards scenario B. Here, the Federal Reserve is forced to be the buyer of last resort. In simple terms, it has to print money to finance the government's spending. This is what Ray Dalio warns is a monetary order breakdown. It devalues the dollar, which means everything we import, from phones to cars to clothes, gets way more expensive. And that problem is made even worse by the current 16.9% average tariff rate. But there's a third, sneakier risk. A balance sheet recession. This is when everyone, from big corporations to regular families, is so buried in their own debt that they just stop. They stop spending, they stop borrowing, they stop investing. It doesn't matter how low interest rates go. The entire economy just focuses on paying down debt, and growth grinds to a halt. And with our country's financial position, with the rest of the world at a record low, we just don't have the same financial cushion we had going into the 2008 crisis.
Okay, so faced with these pretty tough scenarios, what's the verdict here? More importantly, what are the key signals that you should actually be watching for?
Here's a simple playbook. First, keep your eye on the 10-year Treasury yield. If that number breaks significantly higher and stays there for a while, the basic math that holds up our housing and stock markets could start to crack. Second, it might be time to reevaluate your assets. Experts like Dalio suggest that in times of currency devaluation, things like gold, assets that aren't someone else's debt, become a lot more appealing. And third, you have to understand the bottom line here. The path we are on is just not sustainable. The hard choices, either through higher taxes or cuts to future benefits, are becoming a mathematical certainty. Look, for decades, the U.S. has enjoyed what's called an exorbitant privilege because the dollar is the world's main currency. It's allowed us to borrow cheaply and, frankly, get away with things other countries couldn't. But that special privilege is now wearing thin under the sheer weight of our debt. We aren't just in some normal economic cycle. We are entering a new era of structural, long-term volatility.
Which really leaves us all with one final and pretty crucial question. The foundations of the global financial system are shifting. So, is your portfolio prepared for what comes next?